welcome everyone to the webinar. I don't think I will take more than an hour and a half max of your time. The objective of this webinar is to share some views with you on the specifics of company valuation and due diligence process in Poland and things that impact on mergers and acquisitions here. It's largely my personal view based on experience. So obviously you may not agree or discuss that, and I will be happy to hear those comments or remarks. But basically, why am I talking to you? Grant Frost is a financial consultancy. So what we're doing, the majority of what we're doing is financial modeling and transaction services. So that gives me a little bit of experience to talk about those things. We've been through a number of transactions, mostly in the middle market. Of course, the large transactions are serviced by other companies, but we do have significant experience in this middle market. We also do accounting services. We consolidate things. So very often we have some view on what happened after the acquisition, where the entity that was an acquirer also allows us to do the accounting, the bookkeeping for the subsidiaries. So basically we know what happened after. And we've been in the market for 12 years. We have 50 employees in Poland, and we service clients in Poland and abroad. Our typical client profile is a financial institution. They do a lot of transactions, obviously, venture capital funds, private equity funds, accounting services. What we do is usually stock listed companies or subsidiaries of foreign companies. So that's what I was telling you, and that all basically contributes to some points that I may have on the mergers and acquisition. So what I'm planning to talk about during this session is, first of all, very brief, a few slides on what happened in the M&A market in 2023 in Poland and how perhaps it was different to what happened elsewhere. And then we'll talk about some typical due diligence risks in acquisitions of entities here in Poland, and we will split that into small companies and medium-sized companies, and then I'll talk a little bit about the determinants of value. So basically, what makes Polish companies valuable, or what negatively impacts the valuation of those companies, and how the transaction price is determined, a little bit about earnouts, and a little bit about closing mechanisms, and finally a couple of slides about the impact of war in Ukraine on the valuations and potentially on M&A. And of course, if at any point in time any one of you have any questions, please do not hesitate to ask them immediately, so we might have some discussion on certain points. So first, the overview of what happened in 2023. So Poland was reasonably active. There was an estimated 366 M&A transactions, and that was an increase of 7% compared to the prior year, which basically means that this market remained active regardless of the fact that it wasn't necessarily that active in other places. We had some big transactions, obviously, like Tencent acquiring Techland, a software company, for $1.6 billion. The red arrows basically are when a foreign entity entered the Polish market with the acquisition, perhaps with the exception of Meridian, that only increased their stake in Autostrada Wielkopolska, but other entities entered the Polish market or already were present in the Polish market, like Leasner, and bought a major manufacturer. Tencent is basically on a shopping spree in Poland. They bought a number of software companies here. The blue arrows represent Polish companies' investments abroad. So we have Masmax, the beverage manufacturer, buying Bekarówka brand, which was maybe not sizable, but definitely something to bear in mind, because Bekarówka is obviously a very well-known brand. We have InPost buying Menzies distribution in the UK, and the green arrows are the acquisitions that were done internally by Polish entities. And we have what I put here was two venture capital funds, Innova and Enterprise Investors. Enterprise Investors renewing their portfolio, Innova constantly looking for a buy and build projects. Here they bought Plyderer with a bunch of private investors. Of course, what you see in the picture is just a selection of a whole range of transactions, because we had 366 of them, just a couple of them on the screen. If you look at sectors, obviously, the majority of transactions take place in technology sector, which is the hottest at this point in time. 57 in consumer goods and services, 25 in medical. But interestingly, in medical, the majority is about clinics. So it's a little bit of consolidation. I'll talk about that in a minute. Medical testing laboratories, which is also a part of market consolidation, and drugs manufacturing, sometimes much less than the previous two. And 20 acquisitions in energy sector, broadly speaking, energy sector, but obviously usually connected with the renewable energy. The key market remains technology, as I said. Poland has been very active in the acquisition of business in technology sector. So we have a lot of software houses to which a lot of coding work was outsourced. We have a lot of game developers, and those companies now become potential targets for acquisitions, especially if they're well managed and properly operating in the market. Another characteristic of the market is the consolidation process that takes place in a variety of industries. Here I mentioned three examples which I find most visible, which is car dealerships. This market used to be very fragmented, and each dealership was basically a family enterprise a few years ago. Now it gets professionalized, and there's a lot of consolidation, both from Poland and dealership chains from abroad entering the Polish market. Medical and veterinary clinics, as I said, there's a lot of consolidation on this market as well. This market was thought to be a difficult one in the past because, especially with the medical clinics, they were told, or they were supposed to be based specifically on the skills of the key MD that basically started the clinic. Over time, as they grew and the impact of the founder was lower and lower, they became potential targets for acquisitions. And now this market is very vivid. Employee benefits consumption, as again, a little bit of consolidation on the gym market, for example, with two major players competing for gym chains and individual gyms to consolidate it. A lot of private, well, maybe not a lot because there's just a few of them, but a lot of money involved with the private equity and venture capital firms looking for scalable projects. They have money from their prior investments, usually very successful. They're looking for new ones, and that they already crossed the borders. They're looking all over the place in Central and Eastern Europe, but they're looking for projects which may be scaled, and sometimes they're looking for those projects providing finance and hoping for the expertise to come from someone else, so they partner with business people as well to make those acquisitions. And one important thing is to bear in mind that Poland has already, in a number of markets, has to be considered a developed market. So it's very difficult to enter this market greenfield, and therefore the M&As become a good and usually a cheaper basis to enter the market by buying some successful or reasonably successful player rather than starting everything from scratch. Now, what will influence this market over the coming years, obviously the key factors, is still the expected high rate of growth in GDP over the coming years. Probably 2024 actually will be lower than that, but in the long run, Poland is still assumed to grow at a high pace. And another thing is the release of the EU reconstruction funds. As you probably all are aware of, they've been blocked for a number of reasons for some time. They've been released now, or they're being released now. The amounts are considerable for Polish economy, with the majority coming to energy sector, mobility and zero emission mobility, health, digital transformation. These businesses will have a chance to get some financing with no cost or low cost, basically. On the negative side, we have the inflation uncertainty. The inflation has fallen significantly over the last months, but basically nobody knows why. And just like nobody knew why it increased in the first place a couple of months back. So there's still uncertainty of what will happen, how the government actions trying to reduce the inflation, how they actually impacted this process, and whether they can continue in the future. On the plus side, on the other hand, we have a lot of succession in the market. There's a lot of businesses that were started back in the 90s. Now their owners are 30 years older and they're looking for succession. If they cannot find one in their families, they are ready to sell. And that creates a market for potential entrants or consolidations. And last but not least, the energy sector will still enjoy a lot of M&As, probably because of the forced change of energy mix. Poland, with still reasonably high dependence on coal and fossil fuels, has to change the energy mix. It is changing, and it is changing fast. However, there's still a lot to be done, and therefore there will be opportunities in this market as well. Now, back to the general subject of this webinar. Let's talk about due diligence a little bit. First, what due diligence is all about and what it is not about. Due diligence process is obviously the analysis of data, the financial data. Well, I'm a finance person, so my concern is not the legal due diligence, the financial due diligence. And obviously what we do there is we analyze the financial statement, trial balances, management reports. We analyze trends to see how the company has been performing, and therefore what are the outlooks for the future. Our job is also aimed at identifying one-off and non-typical transactions, because if the prior year's earnings were affected by one-off events, they shouldn't be factored into the price in the transaction. And also non-typical events generate risks that might also have to be addressed in the share and purchase agreement. We also determine whether the numbers make sense altogether. So we're trying to figure out whether the numbers that were presented to the potential buyer were presented bona fide from what the company did, or were they to some extent manipulated to provide for better results. And within that, one of the things is obviously application of accounting rules. We're looking for aggressive accounting policies and premature revenue recognition and stuff like that. We also analyze contracts, appropriateness of their reflection in the financial statements, obviously. So how those contracts were translated into the numbers in the financial statements. And again, premature revenue recognition or deferred cost, this is what we're looking for. And we're looking for consequences of those contracts for the future, meaning that if there is a contract that might generate some risks, some financial risks, some financial obligations on the side of the company, and those risks or obligations are not reflected in the numbers, we're trying to adjust for it as a result of our due diligence. So we're not really auditors. This is extremely important. We're not looking at the financial statements with the view of whether they comply with some law or international standards. We're looking at the financial statements of whether they basically comply and properly reflect the business that stands behind. But one important thing, it's not a forensic investigation. So during the due diligence process, it is very difficult, not impossible, sometimes it happens, but it's very difficult to detect fraud because simply the procedures are more analytical than the substantive on the due diligence. We may suspect that something is wrong, but we will not find evidence for that. Now, my personal experience and due diligence risks in Poland, some of them are probably characteristic of many markets, but definitely are characteristic here in Poland. Key due diligence risks, first in small businesses. So obviously the first thing is the owner's cost or provision of free labor. So that's the two sides of the same coin. So first of all, we may expect that the costs as reported by the company are slightly higher than they should be, quite obviously, because the owner, if he is an owner of the business, would drive a better car than a manager and then an externally hired manager would if the company was externally managed. So there will be some extra costs there, and we have to remember that because the owner will remember that. So in determining the price, the owner will always claim that the cost base will be lower if he leaves the company because certain costs are basically private but covered by the company. But on the other hand, what we have is free labor because the owner obviously lives off the profits, not of the salary. So if we are to replace the owner with an externally hired manager, we have to consider the fact that there will be some extra costs here due to the fact that we'll have to pay the manager's salary. And that is something that owners never remember about. They will always try to convince the buyer that they don't do anything in the company. They hardly go there. And I've been through these talks many times, definitely more than I would like to. But the actual determination of the contribution of the owner to the well-being of the companies is one of the most important aspects of due diligence in a small business. We need to clearly find out what the owner, sometimes his wife or spouse or children, how much they are involved and what will happen when they disappear and what extra cost that will incur. Very important thing to determine during a due diligence. Now, the second thing is related party transactions. And very often the private business people will have some additional businesses, some extra activities. And obviously, I'm not saying they do it, but there is a risk that some of the profitability of the business they're selling will be impacted by the fact that they have a side business. To give you an example, if there is a guy who has a gym and you want to buy this gym, we need to ascertain who is the owner of the space, of the location where the business is. Because very often it's the same guy that owns both, or it's his cousin or brother-in-law or someone like that. And basically, very often the rent here is at non-market rates, and therefore the profitability of the gym is impacted by the amount of the rent. So that's something that needs to be investigated during the due diligence and clearly determined whether the profitability would stay the same if that business is bought by someone else. A very important aspect here. Another thing is non-core activities. If you're a private entrepreneur, you're free to do everything with the business that you're in, and therefore sometimes if you have an interest or whatever in horses, you may have a stable that is basically within the same books with the business that you are actually trying to sell. And then the separation of these and the determination, the proper determination of links and where the costs go and where revenues come from is extremely important. Those non-core activities, very often, it's very difficult to separate them out, and it's very difficult to actually say where the mind of the owner was really focused. Was it focused on the business that you want to buy, or was it more focused on the side activity that he or she was pursuing? Both have an impact on the price, and both have an impact on the well-being of the company that is being sold. Now, a typical case for small entities would be unmitigated risks. Unmitigated market risks. So very often you will see a business that was very profitable, but this profitability is based on the cost arbitrage. So basically the costs in Poland are still much lower, both in terms of salaries and in terms of other services than in the Western Europe. So it's reasonably easy to make a profit if you have some commodity that you, or some merchandise that you, or some service that you would be selling in the Western market, but have a Polish cost base. That leads to profits, but it also leads to the fact that the owners of such businesses don't really care about mitigating the foreign exchange risks. They don't care, right? Because if foreign exchange rates change, they might not get the profit of 100, but of 80. It's still a lot. It's good, right? It's enough. Obviously, for you, when you have to put the money on the table for that business, it is extremely important whether the profit is 80 or is 120, or whether you don't actually know whether it will be 80 or 120, because it's so hugely dependent on unmitigated foreign exchange risks. So that is something to, again, take into consideration during the valuation process and during the due diligence process. And also what needs to be taken into account is that eventually, when you buy this company, you will have to deal with this problem. You will have to employ some kind of a hedging strategy in order to stabilize those profits. And basically what level they can be stabilized at is a mystery that has to be solved before the transaction. Now, another thing is dependence on a small group of B2B clients. Very often businessmen want to sell their business just when they have a big success, and that success is when they made a big profit. But the question becomes, is this a sustainable profit, or is this a profit because they won one big client? And unfortunately, more often than we would like to see it, it is because they have just one big client. Dependence on one client or a small group of clients is always a risk. It can be factored into the valuation. Quite obviously, the sellers won't like it, but they need to be convinced that the fact that they deal with one significant client does not make it a fantastic business. It's actually very risky. Dependence on the owner, I talked about it a little bit. So how much work does the owner really do, or work, but or how important his personal contacts are in sales, for example, because maybe 90% of sales are just possible because that person is a well-known, whatever, legal professional, and therefore the business? Is it a standalone business with the capacity to work on its own, or is it fully dependent on the owner? And one more thing is the non-differentiation between cash and profit, or as I said, greed. Poland is a fresh market. There is no old money here, and therefore the approach towards money is slightly different. And a lot of businessmen, I'm not saying this is a blocker for any transaction. It just has to be recognized and understood. Some businessmen fall into a trap. So if their business is going good, the cash is good, then there's always a banker who will tell them, well, you've got fantastic profits. Maybe you would like some financing from us to get even more profits, right? So bank adds some more money to that business, but to the guy here, both of these sources look exactly the same. So they're using the bank's money for immediate consumption through the business. So they're basically buying Bentleys and whatever, IMG, Mercedes. So they're spending the monies they get from the bank, not to grow the business, but to consume. And basically this confusion between the money earned and money loaned, or borrowed in this case, is very important to understand and to identify this in the company that you're potentially buying. This is an opportunity. On the other hand, obviously, you will not take the liabilities related to it, but it's even easier to negotiate if you see the high debt that was actually consumed by the owner. But this is something you need to realize and recognize in the transaction. With large or medium-sized businesses, the risk that we might face are also the dependence on small group of clients. There is a lot of businesses that grew significantly by, for example, trading with large retail networks like Carrefour or something. They rose to unbelievable sizes, especially if they managed to go out of the Polish market and they deal with Carrefour on a European basis. They're really big businesses, but still dependent on one or very few clients. So that risk might also be applicable to larger businesses. With large businesses, we will have the aggressive accounting policies. We won't have them with small businesses because they don't realize that they don't even realize they could do it. Large businesses do realize they can do it. They have finance directors, they have people who are well educated and know what are the drivers of value. So with the larger clients, you will obviously have the revenue accruals, which may not materialize. They were aggressive to that extent. You may have lacking provisions for risks that are definitely identifiable. And obviously, you may have a lot of ideas for increasing EBITDA just to increase the price, including, and that is my personal experience, well, my personal business experience, including fraudulent transactions, non-existent transactions, or a common fraud, not typical to Poland, but definitely used in Poland, which is taking money out of the company and pushing it back to the company through revenues to increase EBITDA and therefore increase the multiplied value. If you saw the film, I think it was called The Accountant. This fraud was beautifully pictured in that film, and it does happen in Poland as well. Poor financial planning. So some businesses are to be sold, so they are for sale when the owner sees that they will not be able to renew the financing. They get to the wall and they get up against the wall. The banks won't renew it for some reason, and then the only way to survive is to find an investor or to sell that business it does happen because very often there is poor financial planning, in the sense that if we've got the financing, it's good, but if it ends, we have no plan B. And we never thought about discussing with bank what they would want to renew the loan or whatever, right? We're waiting until the end, and then we see what happens. And sometimes the banks won't finance the business anymore, and that also creates an opportunity for a merger and acquisition, by the way, if the buyer has the financing secured. Again, unmitigated market risks. We have the same problem even with large scale businesses, and we have working capital issues. I will talk about that a little bit more when we talk about valuations. But basically, the thing is that working capital management, just like for financial planning, working capital management is not a strong point of Polish companies. So very often what they do in order to achieve the growth is they sacrifice their working capital. And as always, it is, it will be somehow, we will work it out. We will work it out. As I said, I will talk about that a little later. And two tax risks which need to be, I'm not a tax expert, so there's probably plenty more tax risks involved in a due diligence. But the things that come out even in the finance due diligence, or the things that are very often discussed between the finance and tax teams, are the transfer pricing issues. And now, basically, the government now in Poland, or the tax authorities in Poland, are really very active in pursuing two types of tax inconsistencies: transfer pricing and VAT. Right, so these two things have to be really, really well managed, because basically tax authorities consider these to be the major source of potential extra revenues, rather than checking if someone deducted properly some non-deductible costs. That's monopoly money, right? The real money is in transfer pricing and VAT. So this is what they're focusing on, and during the due diligence process, a very important part is to determine whether the transfer pricing risks of prior years are properly managed. Of course, in an SPA, you can transfer the responsibility for that to the previous owners. However, the problem will still be yours to some extent, even if the financial consequences won't. And VAT risks, the same situation. Polish VAT is told to be pretty complex. I don't know whether it's true or not. Don't know VAT regulations all over the world, but it is manageable. It is manageable, and it has to be managed properly. So definitely, VAT is also the thing to look at while doing a due diligence. All right, moving to the determinants of value. We've got a picture of a typical DCF valuation. So starting from earnings before interest and taxes, we will talk about the items that contribute to the ultimate value of the company. So what makes the EBIT is obviously revenues and expenses. And in terms of revenues, we have to remember that Poland is still a market where you can probably achieve more growth than in well-established environments of the Western Europe. There is, even if it's an expert business, you can always still count on some form of cost arbitrage. So there are opportunities for growth, and that has to be reflected in the forecasts. And the reflection of this in the forecast would also be expected by the seller. So even if you're selling a business that is quite well established here in Poland, like a medical laboratory, you still expect growth, which will be in excess of inflation, because the people get richer and richer, and they consume more, and the GDP growth is fueled by internal consumption. So the growth, even if only internal, is substantial, or can be expected to be substantial. In the residual period, in our models, we usually assume the residual rate of growth of 2.5%, which is the long-term inflation, just to stabilize that growth in the residual period and not forecast anything funny there. But before that residual period, revenue growth is usually considered to be higher than that. On the expenses side, one thing to remember is that we have labor costs. I've been talking about the cost arbitrage, and it still does exist, but it is getting smaller and smaller. Labor costs over the last years were on the extreme ride up. The factors that contributed to it is primarily the full employment that Poland has been experiencing for the last few years. So there is an extreme pressure on employers to increase salaries. And over the last couple of years, the minimum wages were also increased dramatically. It was an increase, I think, over a couple of years, it was an increase of 100%. And now, given the strong zloty, the minimum wage is, I think, in the region of 1,000 euro, depending on the foreign exchange rate, which is a dramatic change to a couple of years ago when it was at the level of 250 euro. Obviously, the minimum wage impacts on salary expectations in every corner of the market. So there is a huge pressure. And as I say, this pressure is even more fueled by the fact that there are no available employees to hire. I mean, you can hire them, but basically you have to probably overpay their previous employer. In the valuation, therefore, these factors have to be taken into account. So if someone assumes that their revenues will grow at a high rate, but their labor costs will only grow at inflation, that's just imaginary. What we forecast in our financial forecast in financial models is usually the growth of salaries in excess of inflation, sometimes significantly, at least 1 percentage point above inflation. And that obviously puts a strain on future margins. The next two items that I wanted to discuss is the first is the working capital issue, which I promised to come back to. Working capital is poorly managed in Poland. As I said, a lot of companies in Poland grow dynamically because they win clients very often from, or they win business from Western companies by promising or unconsciously promising those clients that they will take away their working capital problems. And so basically, to give you an example of that, we had a client some time ago. I was manufacturing something, right? And for that something, they had to import components from China. And obviously, it took 6 weeks before they got to them. They had to pay cash for them because they took too little to get credit from the Chinese business. The manufacturing took another 6 weeks, and then they delivered this to the client, and the client took 2 months, so 8 weeks, to pay. So their working capital cycle was 20 weeks, nearly half year to finance that all. And they had a lot of business, and it's not surprising. I would buy from them, right? They are removing all my problems with financing my supplies. They're paying for 20 weeks of time and money involved. So they won a lot of business. They had excellent profits, and never had any money. They were always nearly bankrupt because they couldn't handle it, because they received money so late that by the time they received money, they had new clients expecting new deliveries. So for them, winning a new client was the worst news in the world. And unfortunately, it happens very often. Interestingly, if you get a financial forecast from a client, it's never reflected there. From client's perspective, the working capital will always be positive. How come? I mean, in a growing business, it cannot be possible, but they will always fill the numbers in such a way that it comes out positive. It's always negative. It's always negative, unless very well managed, which happens very rarely. So the impact on valuation, in my experience, is always negative. And CapEx, what you have to be aware of with the acquisitions here, I mean, maybe everywhere else in the world as well, but definitely here, is that Polish businesses tend to overtrade on CapEx. So they use the fixed assets until they're dead, really. They tend not to renew their machinery until it is no longer capable of working. And then again, we saw a number of cases where when the machinery was getting close to that technological end, then it occurred to the owner of the business to sell the business because they had excellent profits. The machinery was fully depreciated, so no more costs related to it, excellent profits therefore. And when the owners saw that actually, oh, in a couple of years, it seems like we will have to spend a lot of money renewing the whole machinery, then he came with a brilliant idea of selling the business on large profits, right? And if you don't consider CapEx, if you offer him, I don't know, whatever, oh, great, 10 times EBITDA, you're really screwed because the moment you buy it, you'll have to buy the full new machinery set. So again, and a big emphasis should be placed on the CapEx and potential overtrading of that business. Cost of capital here in Poland, the parts that make up the cost of capital, obviously the risk-free rate, which currently stands at 5.22, well, for our calculation, but basically around 5. And it's high. It's high, and that leads to very strong zloty, but that's the way it is. And the expectation for the decrease in the price of money is, some people say 2025, the pessimists indicate 2026. So we'll see about that, but right now the interest rates are high. The yield curve suggests that they would be falling, however, not dramatically. So I think the fall in 2025 is a justifiable assumption. Now, equity risk premium, which is also an element of the calculation of cost of capital, the equity risk premium being obviously the premium that the investor would request for investing in a fully diversified portfolio of shares, is basically an indicator of the riskiness of investing in a given country. So right now, as per Damodaran, so it's basically valuation guru calculating those indicators for each country in the world, basically. He says it's 628 for Poland, which is modest. However, it was 714 at its peak when Russia invaded Ukraine, and it was 5.5 more or less at its best times before the war and before COVID. So right now we're somewhere in the middle in terms of perceived riskiness of investing here. Another thing that would impact the calculation of cost of capital is obviously the specific risk, but that is a risk specific to the given business, and it may vary. And basically, that is pretty much these are the two major factors contributing to the cost of equity of investing in Poland. The cost of that is, well, at least the way we calculate it, is also based on the risk-free rate and the margin, and these are some reasonable margins for big businesses, so around 1, maybe 2 percentage points. For smaller sizes of businesses, we usually add some additional premium because the banks will also be willing to add a bigger premium for smaller businesses. Now, going to the specifics of transactions in Poland, and just superficially, obviously, because we only have 1 hour, but superficially going through these points. First of all, EBITDA multiplier is the most common rule of thumb. So before the transaction, if you start talking price, everyone's looking at EBITDA multiplier. And obviously, we can talk about a decent multiplier, but then we need to clearly define EBITDA, right? Please remember, as this is, my background is accounting, so I know that EBITDA is not defined by any standard. It has to be clearly defined in the SPA. What is in, what is out. Especially with bigger businesses, we will have a variety of problems. Like, for example, how do we treat EU subsidies in the EBITDA, in or out? How do we treat profits of associates, in or out? How do we treat profits on sale of subsidiaries, in or out? These things have to be clearly understood and determined. How do we treat impairment, in or out? These things are critical then to avoid potential litigations. Now, valuations of 5 multiplied by EBITDA are rare. Okay, well, we had some clients from a country that I will not mention, and they were saying, oh, we will not pay more than 5 times EBITDA because in our country we pay 3 times EBITDA. Well, maybe you do, but in Poland you wouldn't buy anything for 3 times EBITDA. And as I say here, and if you do buy, then it's probably something you don't want to buy, because then someone obviously was pretty desperate and wanted to sell quick. 5 times EBITDA is very difficult to find unless, well, okay, with coal-fueled industry, you might find good valuations, but again, who would want to do it? Now, because of what I told you before, the expectations of growth and economic development, the expectation of EBITDA multiplier in a good business is between 8 and 10, depending obviously on the prospects of the business. Do not buy on reps, do not buy on representations, do the proper due diligence. We had people buying just on the promise of the seller that everything is right and taking all the responsibility for anything being wrong. Except that if you want to actually use those representations, you have to go to court. And in Poland, it's extremely, extremely inefficient. Courts are overburdened. Even if you get to a court and you get your case listened to, the judges are usually lacking financial literacy. So you don't know what the outcome will be, but you know one thing, the outcome will come after 5 or 8 years. So this is not how long you want to wait for your money if someone basically cheated. And therefore, something that I always encourage is the use of arbitrage. By that, you are likely to increase the level of financial literacy of the judges, and you get some more certainty in terms of how long you might wait for the actual resolution. And deferred payments, if you want to go for deferred payments, it's not customary and unwelcome. Of course, everyone would prefer cash up front or cash and earn out. And deferred payment is, again, it's my experience, but it is only accepted if you want to defer some amounts due to the representation and warranties as a security for meeting the representation warranties of the seller, and only if you put it on an escrow account. So usually Polish entities do not agree that the payment is just withheld and stays with the buyer, right? They don't believe they would ever be able to claim it, especially, quite sensibly, they usually sell to a much larger institution with which they have very little bargaining power. So what they need to be sure is that if anything is deferred, it will be fairly treated, and the payment of that deferred payment is not dependent on the will of the buyer. And even if you want to protect your reps and warranties with an escrow account, it will still be difficult for tax-related representations, because usually in the share and purchase agreement, the tax-related representations have to last for 6 years, which is the maximum amount of time the tax authorities have to audit the numbers of a company. So it is unlikely that you will find a buyer willing to withhold his money on an escrow account for 6 years. All right, so these tax representations have to be dealt with in some other way. Now, earnouts, on the other hand, are common and frequently used, especially with growing business, and especially if, obviously, the management stays in the company, all right, the previous owners. Obviously, the earnout only has any point if the recipient of the earnout has any impact on the performance of the company. So, yes, I think it would be easy to suggest it, and easy, therefore, to reduce the purchaser risk in the transaction if you offer an earnout mechanism. However, again, just like for EBITDA, earnout must be very clearly defined with very simple terms. And again, my personal suggestion is, if you want to put earnout in an SPA, remember that the earnout mechanism has to be described not only by the lawyers, but by accountants as well. If you leave it to the lawyers, with all the respect for lawyers, they have no idea what profit is. They have no idea about the difference between the profit and receivables and stuff like that. They have no idea between the difference between the flow and the balance, and therefore they mix those terms. What comes out is a monster that if you want to then settle it properly, is ambiguous and difficult to actually deal with. And because of that, it very often ends up in courts or arbitrage. And as I said, the court resolutions will be very late and very random. So again, if you put earnout in your SPA, try to also use arbitrage as a means of agreeing. And first of all, negotiate, obviously, negotiate, because they might, especially if earnout is ill constructed, it's better to negotiate it, to have a common understanding between the buyer and the seller that it was ill constructed. We have to clarify things. That first negotiate, then go to arbitrage and construct SPA in such a way. If you put earnout in the contract, you have to remember about two things. The seller may not be willing to accept earnout if they, for example, will be, well, after the transaction, they will be bound by some new introduced group strategies. So basically, if you say, okay, I will pay you some extra if EBITDA is X, but then you introduce 500 procedures of how they can sell, how they cannot sell, and so on, then the previous owner will say, look, I knew how to generate a bid down my terms. I don't know how to generate a bid down your terms. So it's very difficult for me to meet the earnout requirements based on your procedures. And in some cases, it might even not be possible. So they will feel cheated, and that will not be a good start. On the other hand, the sellers, the previous owners, might do exactly what I told you before. They might overtrade in order to increase the results for the purpose of winning earnout. So earnout mechanism has to also be protected from that potential impact. And generally, from the perspective of the seller, the locked box mechanism would be preferred. So the locked box mechanism, meaning that we agree on the price based on the due diligence presented numbers, and these don't subsequently change, and the price doesn't subsequently change. Obviously, this arrangement is very difficult to accept for the buyers, because they will say, well, it will take time before due diligence, up to the moment that we can actually take control of the company, and over that time things may change. So we would probably prefer the completion accounts mechanism, according to which the actual transaction price is modified at closing with the changes in the financial situation of the company between the due diligence time and the closing. And most of the sellers would agree to it, provided that the generation of those completion accounts is well determined in the SPA. Because you have to remember, one important thing is that completion accounts will be generated when the owners are no longer the owners of the company. So technically speaking, the buyers may cook the books on completion accounts and present whatever they want. And I saw situations like this where buyers were not bona fide, and they were, after the acquisition, they said, oh, no. Unfortunately, we needed to make a lot of provisions, and therefore we have a huge working capital adjustment or something like that. You know, to make things fair on the level of SPA, these things also need to be addressed. How the completion accounts will be created, under what rules, clearly define those rules, and operationalize how those completion accounts would be put together after closing. And the last part of this webinar is the war in Ukraine and the impact. Of course, there is some impact because Poland has a long border with Ukraine, so we're basically nearly on the front line. And what is important also in the relationship with Ukraine is that we have very close historical, cultural, and linguistic ties. So the history, as always with neighbors, has been you know, difficult in many aspects. But right now, what is more important is obviously shared mistrust for Russia. This is a link. One link that we cannot forget is also the linguistic link. You know, Slavic languages are generally similar, but nothing is as similar as Polish and Ukrainian. Polish and Ukrainian shares 70% of vocabulary, which means that basically until you start talking about quantum physics, those languages are basically mutually intelligible. Of course, there's a difference in accent, blah, 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 but if you speak slowly on a day-to-day matters, Poles and Ukrainians understand each other. That is a very, why am I talking about this? It's because it is so easy to work with Ukrainians, to have them as your employees. They don't have to learn language. They don't have to learn procedures. They have very similar culture. They know, you know, the ways of working in this country. They've been coming here for long years, and they basically speak the language, or they can communicate, which makes them perfect employees, and Polish employers have been using this for years. They were coming here, the Ukrainians were coming here to work. Of course, currently, it's more difficult for men. Men are usually kept in Ukraine for war purposes, but a lot of women moved here, and sometimes stay here and work and have their lives basically set up here. Generally, then obviously the impact of war is negative, but there are some positive impacts, however badly that would sound. So first of all, war proximity increased the equity risk premium, right? Being brutally honest, it increased the risk of investing in Poland. And as I showed you, it is the equity risk premium is still at a higher level than before the war. Polls, based on the polls that were generated here, actually fear that there might be a direct Russian invasion, and it impacts on their choices. It impacts on what they do and how they do it, and that fear is quite present, and you can see it, you can feel it here in Poland. One thing is that the Russian market is now closed both ways, and some businesses in agriculture were dependent on the Russian market. There was a lot of exports to Russia. Gradually, less and less, because Russia has been closing their markets for years. But those businesses had to find alternatives, and in the majority of cases, they did find alternatives, which therefore was a negative impact initially, but now does not play an important role. And finally, the impact is the increased defense budget of the Polish government. Obviously, now there is a lot of arms buying attitude within the government, and therefore the EU deficit thresholds will probably breached at some point in time. But on the other hand, it's probably characteristic of more EU countries than only Poland. And as I said, surprisingly, there are some positive impacts. So there is some space for new businesses. There are at least 2 Polish companies, the drone manufacturers, that are flourishing. The Ukrainian soldiers speak very highly of those drones, and the manufacturing goes. The Polish armed forces also buy them, so this business is actually on a rise. There is a big business now in southeast Poland servicing the military equipment and servicing the NATO soldiers stationing in those regions. So a lot of new opportunities are there. And also on the positive side is that the refugees, the Ukrainian refugees that came to Poland, were very quickly absorbed into the Polish labor market. As I said, we operate at nearly full employment, so the new refugees were extremely waited for. This aspect has already been exploited, as I understand. So now, unfortunately, the employers have to go further and look for employers from as far as India and Nepal. But originally, the Ukrainians were a big help. And basically, for reasons that I talked about, any Ukrainian with reasonable skills and willingness to work would easily find a job here in Poland. Thank you very much for participation, and I hope to see you sometime around.